Can you see it?
Yes, I can. Can everybody else see it?
Yes.
Yep.
Yes.
Let's see. Ryan, are you in here? And Nabil, are you in okay?
Yes.
Yep.
Yeah. It was. I think that was my issue. I was in the wrong room. That's a problem. All right. Good evening, everybody, and let's get started. We've got a lot to cover tonight. Zenny, you are up to talk about an interesting week on the markets.
I am, but I'm trying to put a video on
Yes.
because I turned it off, and I'm having trouble doing that.
Is it a video that you're trying to show, or you're trying to turn your screen on?
The screen on. Yeah, I got it. All right.
Oh, there you are.
See me now?
Yes, I see you now.
All right, let me just get my PowerPoint back. All right, can everyone see the PowerPoint?
Yep. Yes.
Okay, great. So my name is Jenny Dima, and I'll be covering the week of November 15 to the 21st. Major market index. As you can see, NASDAQ is the yellow line, Dow Jones is the blue line, and S&P is the purple line. The Dow Jones made history on Friday, as everyone know, November 15, by finishing at 28 points, as well as S&P and NASDAQ hit record highs as well. By Tuesday, Dow Jones finished lower than expected because of the weaker earning by Home Depot and Kohl's that I'm going to talk a little later in the presentation, while NASDAQ and S&P continue to rally. Okay, just give me 1 minute. Okay, so major events. Hulu is hiking prices for its live TV plan by $10 per month. The current plan will increase to $54.99 from previous current fee of $44.99. T-Mobile made news again. John Legere, which is the CEO, will be stepping down in May, but he told investors on a business call on Monday that he will not be around the WeWork, contrary to the rumors and reports that we saw last week. The reason for the leave is the tremendous input that he's been getting from companies that could use a cultural transformation. Amazon is protesting the government's decision to award Microsoft an exclusive 10-year contract to drag the Defense Department into a more modern computing age. As well as another news from Amazon, this week Amazon rolled out Amazon Pharmacy, and it's partnering with PillPack. PillPack is an online pharmacy that has license all across 50 states and fills prescription for customers in pre-sorted single-dose packs. So I have a question for the class. How could Amazon change the pharmacy business, in the future? Anyone?
Hey, Jenny, it's Ryan. I think if we look at the existing distribution network that they already have, it could kind of eliminate what we would think of as a kind of a normal pharmacy. It would be convenient for most folks. I guess similar to the Google talk last week, the concern would be that they then have a lot of your private sort of medical information. So we fall down that privacy rabbit hole again. But I think it would probably be bad news for kind of smaller independent pharmacies if they get into that game.
Correct. I mean, that's what Amazon is going for, it's trying to make it easier for people to refill prescription. And like I said, PillPack, it makes it easier for individuals because it's pre-packed on each pre-packed medication for the individual. So we'll see how that goes. Anyone else?
I would also add that, this is Mike, by the way, that this is kind of a long-term plan, because as millennials start getting older, we are going to start taking more medicines, and we've all grown up with Amazon or know Amazon very well. So we've pretty much integrated Amazon into our lives. So getting our medications from Amazon, I think, will be the next logical step for a lot of folks.
Agreed. Especially we mentioned, the teacher in class, that we don't care much about privacy at the moment. So it's
very true. Good comments, Ryan and Mike.
Okay, moving on. Anyone else? We're good? Okay, some other major events. JCPenney CEO is testing new services while making the store easier to shop. The news was expected positively, and the stock was up 8%. And I believe the news came out on Friday. The new stores will include features like personal styling, instructor-led fitness classes and yoga, barbershop, and among other things. So JCPenney is trying to make some changes. Bristol Myers is expected to complete its acquisition of the biotech firm Celgene. When the news came out, shares of Celgene Myers were down 0.5%, not too much, while Celgene was up less than 0.1%. Another news that I found interesting was, the Dow Jones was hitting 28 points this Friday, breaking a record high. Farmers are having trouble paying their bills. The trouble has begun in 2013 and is made worse by the trade war that has cut export, depressed low prices, as well as extreme weather, including flooding, freeze, early in 2019. So they're having some major problems currently. HP made news again. We covered in class last week. HP rejected the $33.5 billion takeover from giant Xerox. HP added that Xerox offer had significantly undervalued HP, and the deal was not in the best interests of its shareholders. Some other news. Lyft announced that it would partner with Get Company to expand its network for corporate clients. The market shares acted positively, and the stock increased 5.32%. Boeing made news. Boeing 737 lost its title as the world's best-selling airplane. Sales record from Boeing and Airbus show that Airbus A320 has officially received more orders than Boeing 737, despite the fact that 737 came 20 years earlier than Airbus. Another news from Ford. Ford unveiled its first all-electric SUV, the Mustang Mach-E. The project sales will be limited to 50,000 globally in the first year due to some battery issue. But following the news of Ford, Elon Musk unveiled a plan for a pickup truck and making some bold prediction about its capability. Google on November 19 entered the video game businesses with its new platform, Google Stadia, featuring 12 games. So rather than downloading the games or playing them from the Blu-ray disc, Stadia streams games whenever you are. So pretty much it's like a Netflix streaming movies and TV shows. Microsoft revealed a similar product as well, which was called Project xCloud, with more than 50 games to play, but it's expected to launch in 2020. Some company earnings. Home Depot disappointed results on Tuesday, raising doubts about the wealth of American consumers. The firm reported earnings per share of $5.53 on the revenues of $27 billion versus the anticipated earnings per share of $2.52 on revenues of $27.53 billion. The news was not taken very well, so the share dropped 5.4% to $225.74. Another disappointing earnings were from Kohl's. Earnings per shares came in at 78 cents versus the 85 cents that was expected. Revenues came in 4.63 billion, and it was estimated for the revenue to be at 4.66 billion, and stock dropped significantly 19%. So I have a question for the class. So do you think missed earnings are a warning sign for consumer spending or the housing market? Anyone?
I'd be much more worried if I was Kohl's because there's quicker substitutes. Home Depot, you still can't buy like a 2x4 plywood on Amazon. So, Kohl's, I'd be real nervous. Home Depot, maybe not as much. Home Depot goes away with the housing market. Housing market's still pretty strong.
Correct.
I read a good article this week that was talking about retail, and the winners and winners and losers are sort of a zero-sum game right now. Lowe's did well, Home Depot didn't. TJ Maxx and some other discounter did very well. Kohl's and Macy's didn't, and so it was sort of a tit for tat. That the economy, the retail sales are not expanding very rapidly. They're just trading off who benefits from consumer spending, and the discounters most definitely seem to be doing better. I'm not sure why Lowe's did better than Home Depot, but that was the results.
I think the other thing that Home Depot's will be interesting to look out for is they're concerned about the tariffs. The House approved some legislation today about protecting something with the people of Hong Kong and their freedoms, and China is quite upset about that. And they said it's gonna impact. They're gonna take it out on us by the trade war. So Home Depot is also concerned about that as well.
Yeah, support for Hong Kong. They're very concerned about what that's going to do to China. You've seen it in the market in the last couple of days. It's been pretty flat, although most of the news and the earnings reports have been very good, but the uncertainty around China and especially the Hong Kong component is causing the market to skitter a little bit.
Okay. Anyone else moving on?
Hi, this is Chris. I have a quick comment. I just wonder how much of third quarter spending of sales is always kind of attributed to the build up to Q4, Christmas time, and people may not spend as much.
That's a good point.
Particularly this year with a shortened season because Thanksgiving is so late. Although in past years, people just spend a lot more in a constrained number of days. The ones who typically lose when people cut back on their spending are all the independents. And if you start seeing a lot of the independent stores and retail establishments go out of business, that may also trigger some recessionary pulls as well, because it'll push up our unemployment rates and such.
Okay, so moving on with some good.
I'm curious why the partnership with Amazon did not help Kohl's. Yeah, there's supposed to have more people going to stores returning stuff.
So really, that's the big thing: is you go into Kohl's and return stuff, right? Is there any other partnership that Amazon has with them other than a drop-off location?
No, that I'm aware of.
Yeah, that's what I know.
Yeah, there is.
Yeah.
Oh, sorry, guys. It's Wendy. When I dropped off an Amazon package there the other day, Kohl's printed out, like on my confirmation of return, a 25% off coupon for like my entire purchase, and it was valid for a week. And then I made a return 2 weeks later, and it had the same coupon, and it stacked on top of some of their existing sales. So I found it to be really valuable. But no, I don't think there's another like partnership per se.
Well, that's smart on Kohl's part to get you, if you happen to come in the store to do a return, that because Kohl's discounts their stuff so frequently, that could be actually pretty valuable. That's a good strategy on their part. But in general, Kohl's merchandise just has struggled in recent. It's sort of that mid-tier. It's not a discounter and it's not a high-end store, and it expanded rapidly, but it just hasn't been doing so well in the last few years.
So moving on with some great news. Target reported another great quarters. The online sales for Target surged 31%, and the stock was up 9.2% following the results. Earnings per share came in at $1.36 versus $1.19 estimated, as well as total sales came in at $18.7 billion. Versus $18.22 billion estimated. Some other major events that I came across this week: Airbnb had signed a $500 million deal to sponsor the Olympic Games until 2028, as the accommodation booking platform targets the world's biggest sporting event. Another one, phase one of the US-China trade deal could be delayed until next year, into 2020. Resulting for the stock market to go down. Lowe's reported better than expected third quarter earnings. Its earnings per share came in at $1.41 versus the forecasted to be $1.35. So Lowe's did better than Home Depot. Another news that was announced this morning, Charles Schwab is buying TD Ameritrade for $26 billion. The deal would create a firm with roughly $5 trillion in combined assets. Some international news. UK Prime Minister Johnson would like to put an end to a 3-year disagreement over Britain's 2016 vote to leave the European Union. He believes that the news has weakened investors' faith in the stability of the economy and has damaged the Britain's standing. State-owned oil giant Saudi Aramco is getting ready for its IPO. The company is worth up to $1.7 trillion, and it's setting the stage for the world's largest public listing. German carmaker Volkswagen cut its forecast for operation profit and sales growth due to downturn in demand for passenger cars, while keeping in profit and margin a target. The automaker industry, it's facing tough times right now because they're trying to invest more in like clean air, self-driving technology, and at the time of the trade war, it's not helping as well. The stock, when the news came out, went down 4%. Hong Kong domestic economy is on the verge of recession following the city riots. The riots have been hurting the retail industry, service, tourism, aviation, and has caused for severe reputation damage to the city. Some upcoming events that we need to watch out. I know that Macy and Nordstrom reported earnings today, but I didn't get a chance to take a look at it. Of course, US and China trade agreement. We need to keep an eye on it. I know it's not going to take place until 2020. Impeachment hearings and some major earning reports. They're expected to come in the following 2 weeks. It's Best Buy, Burlington Store, and Lululemon Athletica. So one last question that I have for the class. So why are stock markets rising after so much uncertainty in US and around the world? As we saw, the Dow Jones was up 28,000 points on Friday, which was record breaking. So do you think, any feedback from anyone?
I think you hit on some of it there, and I think Dr. Leggio hit on it as well. A lot of the earnings information seems pretty positive overall. So I think investors aren't quite as scared off as maybe they would be if, I guess, companies weren't performing as well and there's this much uncertainty. That probably factors in somewhat.
Right. And I believe the Fed's lowering the interest rates push investors to invest more on stocks instead of bonds. So that gives the stock market an increase. Anyone?
I think we've talked about it a lot throughout the semester, but just realizing that although so much is going on, fundamentals of companies really haven't shown true weakness. Like we've said, quarterly results are still coming out pretty strong. So I think that's keeping the market, steady. Once fundamentals start to deteriorate, that's when I think we should really be concerned. But for sure, emotions are involved in investing. But for the most part, I think things seem to be still relatively healthy.
Agreed. Okay, if anyone wants to share any news I missed this past week.
Hi, can you guys hear me?
Yeah.
Go ahead. Beatrix, we can't hear you now. I can see you talking, but I can't hear you. Yeah, you're highlighted, but we can't hear you. It's odd because I did hear you briefly, but now I don't. You might want to try to log out and come on back in because I don't think your audio. Oh, okay. Still can't hear you. This was a good, while you're working on that, Beatrice, I'll talk for a minute. This was a nice, overview of all that's going on in the markets right now. It was a busy week in the markets and a lot of retail news. And in general, I think your feedback is really good to a very good question. That so many things impact the stock market, and interest rates have been low. These companies are doing pretty well. There's always uncertainty in the markets. Are we more uncertain than other times? Well, some of the wars have calmed down a little bit. In general, things seem okay. The trade talks seem to be going sort of in a good direction. So the market is betting on the strength of the U.S. economy long term. And so in general, going into the fourth quarter, things are looking pretty good. We'll see how it holds up. If it doesn't take much to cause the market to drop in a hurry, and we've seen it drop 30+% in a day. So things can shift, but at the moment, things are looking pretty darn good.
Yep, agreed.
All right, I think that's Beatrix coming back in. Let's see, give her a second to see if she can respond. Go ahead.
Hi, everyone.
Go ahead, we hear you now.
Great, thank you. Hi, Professor. Hi, everyone. I think that although there's a lot of uncertainty, one of the reasons the stock markets continue to rise is because economists see.
We lost you. We're not hearing you now. Go ahead and try to unmute there you go. Try now.
Okay.
We hear you.
Can you hear me now?
Yes.
Okay, yes. So I think that the economy is shown to be strong. Like we see the retail that's performing well with the earnings. The third quarter earnings were positive. So I guess that even though there's a lot of uncertainty because the market it's doing good, then the stocks continue to rise.
Yeah. And there's always uncertainty in the markets. And so at the moment, things are looking relatively good. Anybody have anything else that they'd like to add about the market this last week?
I would just add that today the news on Schwab was kind of shocking, I think, to the firm I work in. The analyst that covers the name is basically going to re-underwrite the holding because it completely transforms the business. They're also undergoing, I think, a merger or acquisition of USAA. So there's just a lot going on with that company. It should really be interesting to see how the industry changes, I guess, once, these deals settle. But just I don't know if anyone else has heard that, anyone else who works in the financial industry, but that was definitely a hot topic today.
Becky, how much is it being driven by all of the low fees and such? Are you starting to see some consolidation in the industry just to sort of get better economies of scale?
Yeah, definitely. So the analyst actually shared his thoughts on that and said that given the move to zero commissions, they have to somehow achieve these economies of scale. So consolidation is always a means by which to do that. So I definitely think that's a factor.
Makes sense. That means layoffs are coming, and then you have another whole round of issues with unemployment that causes some instability.
Yeah, to chime in on that, it was definitely a topic on the trading desk as well. Looking at the bonds, they were trading, I think, 4 to 5 basis points wider across the spread. But the stock obviously was, I think, so one of our covers at TD, they're actually pretty positive on the acquisition. And I think both the Schwab and TD stock are trading up, I think, like 25%. And then I think Schwab was a little bit higher than that, which to what you talked about last week with any type of acquisition, it's expected that the bonds, if they're going to, potentially be taking on more leverage, they're going to potentially, I guess, trade worse on the, the fixed income side, but on the equity side, they're seeing it as a definite positive.
Okay. Yeah. It makes sense. As much as that industry expanded, it makes sense to see some contraction, especially given some monumental shifts in how we think about investing and what we're willing to pay for.
Right.
Anything else? Nicely done, Zenny. All right, not that we have a lot to do tonight, but we're going to finish up chapter 8, this last problem. We're going to do chapter 7, and I hope we're going to touch on chapter 14. So take a deep breath, and we'll get started. The nice thing is 14 just pulls everything together, but I don't want to hold all of it until the last class that we have before the final. So let's finish up chapter 8. It's our last problem around using the dividend discount model. So this company is growing very rapidly. Most of you have sent me responses on how you were doing with this problem this week, and I think most of you have gotten it by now. You're growing at 25% for 3 years, and then the growth is going to fall off to 5%. We have a required return of 12%, and they just paid a dividend of $3.10. What's the current share price? Well, the first thing you do with this is figure out what they've told you. So they just paid a dividend of $3.10. That's a dividend sub-zero. It's dividend today. Not part of the stock price anymore, but it's our anchor point for figuring out what the dividends are going to be in the next few years. We're going to grow at 25% for 3 years. We can't use the dividend discount model at this point because in order to use that dividend discount, Gordon growth model, terminal value model, we have to be growing at a constant rate forever. So for the next 3 years, we have to figure out what the dividends are going to be. So start at $3.10, it's going to grow by 25%, grow by 25% again, and grow by 25% again. So we need those cash flows are part of the value that we have in owning this share of stock. But in the 4th year, we start growing at a 5% rate thereafter. Thereafter, forever, in perpetuity, all of those are the signal that, okay, we can use the dividend growth model. When we do the dividend growth model, if we start growing at a constant rate in year 4, that allows us to find the price in year 3. That price has to be added to the dividend in year 3, and then we also have to look at the dividend in year 1 and 2 and take all of that information and figure out what they're worth in today's dollars. So we're going to discount it all at that 12% rate. All right, so when we do that, we started off with $3.10. We're going to grow by 25% for 1 year to get to $38.75. We're going to grow by 25% again for the next year to get to $4.84. Again, 25% to get to $6.05. But in year 4, we start growing at 5%. So the dividend in year 4 is $6.36. Everybody okay thus far? Okay, this is this. Oh, go ahead.
No, I was going to say yeah.
Okay, thank you. I love responses. That's good. Okay, so this is the general formula. If we start growing in year 3 plus 1 or in year 4, that gives me the price in year 3. So my price in 3, or my terminal value in year 3, is the dividend in year 4 divided by the required return minus the growth rate. So in year 4, that price is $90.86. And what does that represent? That represents the value in year 3 of the dividend we expect in year 4, 5, 6, 7, throughout the whole life. So in essence, we've taken all of those dividends and discounted them back to year 3. Okay? So, but we're not paying $90.86 for the stock because that's what it's worth 3 years from now. We need to figure out what it's worth today because we want to buy it today. So we have to take that $90.86 back to today, but we also have to take these 3 values back to today because they're not included in that $90.86. Those are the other cash flows, the cash flows before we started growing at a constant rate. So we have to figure out what those are worth as well. So that said, that's just all the general information. So we had the 387 for the first year, 484 for the second year, and then in the 3rd year, it's the dividend in year 3 plus that terminal value to total out to 96.91. And when you discount these 3 values back at 12%, you come up with a price of $76.29, and that's what you'd be willing to pay for a share of stock today. What questions do you have on that problem?
This is Mike. I did this all in Excel, and each of my cash flows and my net present values are off by like pennies, and I don't know why. Like they're there, but they're just off by a hair, and I don't know where I'm going wrong.
What I would tell you is add in that the end of period, so it's a 0 for end of period. It's funny. I was working on some things for one of my other classes over the weekend, and I was also off by just a tiny bit. And when I put in that 0 for end of period, it resolved it. And I'm not sure what happened and why it wasn't getting me the exact number. But try that and see if that resolves the issue for you.
When you say 0 and end of period, where would I put that? I'm sorry.
So let me pop out of here and go over to Excel to show you. That. And stop sharing that. Let me pull up Excel. Okay, so if you were trying to find a present value, let me do this one, equals present value, and the rate, I'm just using a different problem just to show you number of periods, payment, future value, and see where it says type?
Okay.
Put a 0 there and see if that resolves it. And if not, if that doesn't solve it, send me your problem tonight. Let me take a look at it to make sure that you've got everything right in the formula.
So are we using present value or net present value since there's a series of cash flows?
Well, this is a different problem. So yeah, if you were using NPV equals NPV, and it would be the rate, comma, and then the values, and I don't have, let's say it's these values. And then you don't need to put it,
It's fine. I'll follow with the upper class.
Make sure that you have the first cash flow occurring in year 1 and not in year 0. Make sure you're not including year 0 in there.
Nope, I'm not.
You're not. Send it to me. Let me take a look at it.
Okay, no problem.
Okay. All right. Everybody good with that problem?
So I'm still like a little off. Wait, did you say that you used NPV for this, not present value?
Yeah, let me go back.
That was my issue then. Okay, I figured it out then.
Yeah, you could use present value, but you're going to have to do it 3 times. You're going to have to do the present value of the year 1 cash flow discounted today, the year 2, and then the combined year 3, which is the dividend in year 3 plus the terminal value.
That makes sense why I was off by just a little bit. Okay.
Okay, good. That should resolve it then. Any other questions about that last problem?
So when do we start calculating with the 5% after the 3 years?
That starts in year 4 because that's when we start growing at a constant rate. So that got me my dividend in year 4.
6.35?
I think that sounds right. Yeah, 6.05. And here's the problem. Can you see that? And then you got 6.36 for the dividend in year 4. Yes. And that becomes, are you seeing my screen?
Yes.
Okay, good. That becomes this number here, divided by the 12% minus the 5%.
Because I got that right, the 90.86.
Yes.
But then what I did was to get the 90.86 plus 310 for so no.
No, that 90.86, let me draw a quick timeline. It's a nice neat line. In year 1, the cash flow is 3.875. I'm just going to put 3.88. Oh, come on, stop. $3.88. In year 2, it's 4.84. In year 3, it's 6.05. Plus the 90.86. The 90.86 is occurring right here. So then you've got to figure out what all of this is worth today. So even though the 90.86 is based on the dividend in year 4, it tells you the price in year 3. Pay attention to these subscripts. We start growing at a constant rate in year 3 plus 1 or year 4, gives me a price in year 3. So I have to add that price to the dividend in year 3. And each of these cash flows then has to be discounted back to today. So you need to find the present value of 3.88, discounted at 12% for 1 year. 4.84 discounted at 12% for 2 years, and then 96.91 discounted at 12% for 3 years. And then essentially you're adding these all together. And that's what NPV is doing for you. Makes sense?
Okay, thank you. Thank you.
Okay. All right, let's take a look at chapter 7. The bond problems. You know, chapter 7 spends a little bit of time talking to you about the nature of the bond, and that's important to understand the fundamentals of bonds. But the problems for chapter 7, you know how to do everything in here already. It's just combining things in a slightly different way. So we're going to focus on the problems. So this example is we've got a government bond with 6 3/8% coupon that expires in December 2022. It's a par value of $1,000. The coupon occurs twice per year, semi-annual. The coupon rate is 6.38%, and we're starting January 1st of 2018. So if we start January 1st of 2018, between then and December 20th of 2022, that will be 5 years. So we get 2 payments in 18, 2 payments in 19, 2 payments in 20, 2 in 21, and 2 in 22, because it's making semi-annual payments. So in essence, we're going to get 10 payments over the course of this time. With bonds, the future value of the bond is always $1,000. It's not always $1,000, but it is for our purposes, and it typically is $1,000. A bond has a series of payments. You're going to get a coupon payment every 6 months for a semi-annual bond, and then you're going to get your $1,000 back at the end. And typically, you want to know what you're going to pay for this or what the yield is on the bond. The yield is just what's the rate that the bond is earning. So, so the coupon rate is the same as the payment amount. So our cash flows for the bond are the par value or the future value is $1,000. The coupon is your payment amount that you're going to receive every 6 months. You're often looking for a present value, and if it asks you the YTM or the yield, it's asking you what rate this bond is earning. There are a whole series of bond formulas, but for our purposes, we can use the exact same formulas we've been using as we've done NPVs or present values and future values and rates and ends. We can use those same Excel formulas, and it'll work out just perfectly in here. So for this particular problem, this is what your cash flow stream is going to look like, except there's more 31,875s in here. There's actually 10 of them in here. So this is the first one, and then that one, and then we have 8, 9, and then in the last year you get your $1,000 plus your 31,875. And where did we get 31,875? A 6 3/8 bond means that it's paying 6 3/8% of $1,000 per year, or $63.75 per year. But it's making semi-annual payments, so it's paying half of that twice a year. So $63.75 divided by 2 tells me that my payment amount is $31,875. We get that every 6 months for 5 years, and in the last year we get our last $31,875 plus we get our $1,000 back. And what we're trying to do, if we're trying to find the present value, we're going to figure out what all these cash flows are worth today. And that's how you do a bond problem. All right, let's take a look at what this turns into. Okay, the problem says the required yield is 5%. That's known as the rate, or the yield to maturity, or often it's just written as YTM. Now the yield is an annual yield. So if the yield is 5% per year, then it's 2.5% per 6 months. The only challenging thing with bonds is paying attention to your time period. And it's possible to have an annual bond, but most bonds pay semi-annually, so you have to make a couple of quick adjustments. All right, so to value this thing, what we're going to do, and I'll pull it up in Excel in a second, it's 5 years to maturity, but we get paid semi-annually. So we're going to have 10 more payments. So 5 times 2 per year means my N is going to be 10. If I have a yield to maturity, that's the rate. If the rate is 5% per year, that means it's 2.5% per 6 months. The payment is it's a 6 3/8% coupon. It's 6 3/8% of $1,000 per year, or $63.75 per year, or half of that, $31,875 is my payment every 6 months, and my future value is always 1,000. Now, remember earlier I said, it's good to pay attention to whether or not it's an inflow or an outflow so that you keep your sign straight. This is why you want to keep your sign straight. For bond problems, you're going to pay money out, so your present value is always a negative number. Your payment is cash you're going to receive, and your future value is a cash you're going to receive. These two numbers have got to always be positive, and your present value, if you're putting one in or you're going to get one out, has got to be negative. Otherwise, this falls apart. So just remember that if you're going to buy a bond, you're going to pay for the bond, so the present value is negative, and in return, you're going to get interest payments every 6 months, and you're going to get your $1,000 back at the end of the life. Okay, so when we do that, when we do that, we find that the present value for this bond is $1,060.17. And let me pull this up in Excel so I can show you what it looks like in Excel. All right, so what do we know? Let me get to the right spot. What do we know? We know that our N was 10, our future value is $1,000, our payment is our coupon rate. Our coupon rate was 6 3/8, which is every 6 months is $31,875. Our yield, they told us, was 5%, which is 2.5% every 6 months. So we're going to compute the present value of that. And when I compute the present value, do it because it's, sorry, equals the present value based on our rate, 2.5, number of periods is 10, a payment amount is $31,875, a future value is 1,000. And when I do that, I come up with a present value of 1,060.17. So that's how much I'd be willing to pay today for the right to acquire this bond. Now, I'm only going to get $1,000 back for the bond at the end. Why am I going to be willing to pay more for it than $1,000? The reason we pay more is that our bond is called a premium bond. Ours sells for more than $1,000 because bonds of equal risk today are earning 5%. That's the yield on bonds of similar risk. They're earning 5%, but I've locked in at 6 3/8%. So I'm earning more interest each 6-month period, and so therefore I'm going to get a higher price for the bond. So anytime that the coupon rate is higher than the yield to maturity, your bond is a premium bond. It's going to sell for over $1,000. Anytime that your coupon rate is lower than the yield to maturity, that's a discount bond. It's selling for something less. Okay, so the next thing says, well, what if instead of having a yield to maturity of 2.5%, the same problem, our yield is 11%. So if the yield to maturity for the year is 11%, what would you be willing to pay for this bond? Okay, given that that's all that we changed the yield to 11%, what's going to change in the problem?
The rate to be 5.5.
Excellent. So my N stays the same. It's still going to be 5 years, payments twice a year. My future value in bonds in here are always going to be $1,000. My payment hasn't changed. It's still a 6 3/8% bond, so it's still $31,875 per 6 months. But my rate went from, it was 5% before, or 2.5% every 6 months, to 11%, which means it's 5.5% every 6 months. And then look what happened. We went from having a bond that was a premium bond with a 6 3/8% rate to now bonds of similar risk are earning 11%. So if those people are locking in at 11%, they're getting $110 per year in interest payments, or $55 every 6 months. So they're making more than we are. So this bond is going to be a discount bond. And here's the price that for the bond. So it is indeed selling at a discount. Everybody okay on that one?
Can you just go through that logic one more time? I'm sorry.
Sure.
So the first one, you're saying that the present value is 1,060. and we're only going to get 1,000 back in the end. So we're paying more for the bond in the long run, and basically taking a loss of $60.
Bond today to somebody, you would get a premium. They'd have to pay you more than $1,000 for it, and the reason being is the yield to maturity represents the rate that someone could go out into the market and buy a different bond that has the same risk profile as yours for that yield. So if the yield is currently 5%, that means they're going to get $50 a year or $25 every 6 months in interest payments. You've already locked in at 6 3/8%, so you're getting $31,875. So they like your bond because they get more every 6 months, but to get the right to your bond, they're going to have to pay you more for it. Okay, so whenever your coupon rate is greater than the yield to maturity, the bond is a premium bond. And then the opposite is true. So if your coupon rate is lower than the yield to maturity, it's a discount bond. And that's really important because a lot of times what I see students do is they'll calculate a rate, but they'll forget to double it. We'll see in a minute. They'll forget the semi-annual bond characteristics. And so if you remember premium versus a discount bond, you can always kind of check your work to make sure that you've done it properly. So if your coupon rate is above your yield to maturity, it's a premium bond. If it's below the yield to maturity, it's a discount bond. Does that make sense? I think that was Ryan.
So it makes sense in the numbers, like obviously if the coupon rate, if I'm getting that, but I'm just trying to understand if we're getting, okay, never mind, it's a 7.5 payment. So we're getting $62 a year versus their 50. Got it.
Exactly.
Okay.
Exactly.
Sorry, that was the piece that was throwing me off, seeing the 31.
Yeah, I know. Yeah, that's the problem with semi-annual bonds. But if I teach you annual bonds first, it flips you out when we go over to semi-annual bonds. So I start you with the hard stuff, and then we morph into the easier things in a few minutes. Yeah. So the one that has a 5% yield is only getting 2.5%. So it's only getting $25 instead of your 31. That's why your bond's a premium bond.
I have a quick question just to clarify. So the discount bond is when the coupon rate is lower than the yield to maturity, and the premium bond is when the rate is higher than the yield to maturity,
When
correct?
the coupon rate is higher than the yield to maturity. And the yield to maturity represents what bonds of the same risk as yours are getting in the market right now. So that's the locked in rate right now. Your coupon rate represents the contractual rate that you have on your particular bond. So if you've locked in your contract and your coupon is higher than what current bonds are paying, you've got a premium bond.
Okay, got it. Thank you.
Okay, let's pop back over to our problems again. Oh, who knows how I backed up on these slides? Let's see. I just did that one. Okay, let's do this one. Oh, that's the one I just did. Sorry. That's the one we just did.
Can I just go back real quick to clarification on that? You're using yield to maturity and coupon rate.
Those are two different things. The coupon rate represents the payment amount. So 7% coupon rate represents $70 a year that you're going to earn in payments, or $35 every 6 months.
And that's in our payment.
That's your payment amount. Yeah. So it's a rate, but it's a coupon rate. So it's the coupon on your bond. So it's 7% of the $1,000 is how much interest you're going to earn per year. So coupon rate is different from a yield to maturity. Yield to maturity is what we can typically consider as a rate. The coupon is what we typically consider as a payment. But very frequently, coupons are listed as a percentage. And you just have to remember it's a percent. Coupon is a payment, and it's a percentage of the $1,000 face. Okay. I want you to do this problem now. Okay, so this is a semi-annual bond. The par or face value is 1,000. There's 20 years to maturity. First, do it with a coupon rate of 7%. And it makes semi-annual payments. And I want you to see what the price is if the yield to maturity is 7%, first of all. So first of all, if the coupon rate and the yield to maturity are the same, what are we going to expect the present value to be?
The 1,000.
Perfect. Yeah. And the reason being is that bonds of similar risk are earning 7% right now. That's your coupon. So you're earning the same thing as bonds of similar risk. So your bond should be priced at $1,000. So I want you to do this problem. Let's do the 7% first. I'm not going to put you in the rooms. Go ahead and try it at 7% and see if you get $1,000 for your present value. And then go ahead and do 9% and 5% as well. Now, this is a semi-annual, so what's going to change? This $1,000, what does that become? What is this $1,000 in our problem going to be?
Your future value?
Good, that's your future value. What's our N going to be?
40.
Good, good, Christian. Yeah, why is it 40?
Because we're doing semi-annual for 20
good
annual years. So
good. 20 years semi-annual means my N's going to be 40. What's this represent?
Your rate.
Your payment.
Your payment. And so Beatrix, how are you going to put that in?
7% of 600.
No, 7%.
1,000.
Of 1,000.
Okay. So no, sorry. Yeah.
Okay, 7% of 1,000, and then what do you have to do? That's 70. What do you have to do next?
Divide it.
Good. You got to divide it by 2 because you're going to get 7% per year. 7% of 1,000 is 70, but you only get half of that every 6 months. So your coupon will be half of that, or $35. Okay, keep going. Come up with your present value at 7%. Go ahead and do 9% and 5% as well. But before you do the 9% and 5%, think to yourself, is this a premium or a discount bond? And I'll, while you're doing that, I'll pop up over into Excel so you can see it in Excel.
What were those 2 other interest rates that we have to do?
9% and 5%.
Thanks.
Okay. If you would raise your hand when you're done with all 3, so I'll know when we can start again. Oh, and raise your hand using the remotes as opposed to, since most of you don't have your videos on. Yeah, there we go. Thanks, Mike. Okay, only have three hands so far, so getting there.
Where's the icon that we're supposed to hit to raise our hand?
Yeah, I can't find it either.
Oh, okay. Let's see. Under participants, if you pull up your name, you see can you see participants? Mike. Yep. Yeah, you see it. Okay. Okay, I think we've got a good number of hands up now. Okay, Mike Mason, tell us what you did with the. Go ahead and tell us how you did the problem when we had a yield of 7%.
Can you hear me?
Yep.
Okay, so I'm in Excel. The number of payments is 40. The future value is 1,000. The payment is 35, which is the 7% times the future value divided by 2, the rate of 3.5%, and the present value is 1,000.
Good. So this is what Mike did. That N of 20 means that for a semi-annual bond, that means there's 40 more interest payments. Future value is always 1,000. It's a 7% bond, so 7% of $1,000, 7% of the future value is 70, but we get 2 payments per year, so that means we're going to get $35 each time. The rate was 7%, but that's an annualized rate. We cut it in half for semi-annual, so my rate is 3.5%, and I'm computing the present value. And you should have gotten $1,000 for that present value. Who's got a question? Okay. All right. Who wants to talk about what you did when the rate was 5%?
I can do it.
Good. Go ahead.
Okay, so my future value is 1,000. My period is 40. My rate is 2.5 because it's 5% divided by 2. And my payment is $35. So I got a present value of $1,251 with 3 cents.
Outstanding. Okay, so what changed when we moved our rate to 5%? What we have done is we're locked in at 7%, and everybody else is only getting 5% now. So people are going to pay more for our bond, so it's going to be a premium bond. And indeed, the only thing that changed was our rate went from 7% to 5%. So a 5% rate means that we cut it in half per 6 months. So it's 2.5% rate, and we're computing a present value to get to $1251.03.
Just to understand the logic, as Michael was asking, does this mean that a bond that we have at 7%, it's better than the 5%?
It means you're getting a higher interest rate, which is why it's going to sell at a premium. It means every 6 months you're getting more money, and we always like more money. So if you lock in, when my daughter was born, my first mortgage was at 16%. Rates were very high, and so we bought some bonds for her for college, and we locked in at a rate of 18%. I wish we'd had more money, so we could have locked in more. So those were super premium bonds compared to something today that's at 2 or 3 or 4 or 5%. So what we had done is we locked in at 18%. We were able to get $180 a year or $90 every 6 months. So it was just a really high rate. You would rather have that than a bond that's paying 5%. And so, yeah, the higher the coupon rate relative to the yield, the more premium the bond. Just remember, bonds are contracts. And so whatever your coupon is, that represents the contractual obligation you have with the company to pay you every 6 months. And so that's why the higher the coupon, the better in terms of the pricing of the bond.
Okay, thank you.
Okay. Anybody want to? Oh, go ahead.
What dictates that yield rate?
The yield is based on the yield curve. So what's the underlying riskiness of the U.S. economy right now? What's the inflation rate look like? And then what's the risk profile of your particular company? So if you look at Sears right now, they're not trading anymore, but look at JCPenney right now. Their bonds are their bond rating is very low, so their risk profile is high. So as your riskiness increases, the yield on your bonds goes up.
So if I'm a buyer of bonds, I want to buy premium. If I'm a seller of bonds, I want to be selling discount, right?
Let's see. So you want to buy premium. As long as you believe that interest rates aren't going to go up, I guess you'd want to buy premium. The reality with bonds is there are 10 times as many bonds outstanding as shares of stock, but they're very lightly traded. Most people hold them to maturity, and so as a result, there's not a whole lot of trading that happens with bonds. There's a little bit, but there's not much trading. In general, you want to lock in your bond at a high rate. when we talked about market efficiency and you're earning the right return given how risky your investment is. So if you have a really high coupon rate, it's often because the economy is not doing well right now, that we have a high inflation rate, or you're buying a very risky company. So there's a trade-off between locking in a rate that's high that also has commensurate higher risk. It depends on what your risk profile is.
And with that too, a lot of times these bonds will have call features embedded in them. So if rates do end up dropping, they can call the bonds during a certain time period, and they can reissue new ones at a lower rate.
Right.
But then there's usually like a tender offer where they have a certain price that they've got to pay them out to the shareholder, though.
Yeah, a lot of bonds are callable. Take investments, and we'll get to callable bonds. But for our purposes right now, we're assuming that there are no call features in these bonds, and that once you buy them, you have the ability to hold it to maturity. And typically, bonds are 20-year bonds. Typically.
Can I dumb this down and say like a premium bond is a bond that like outperforms the bond beta? And a discount bond is a bond that underperforms the bond beta, basically, or the bond yield curve, I guess.
It just means that the yield curve has shifted over time. So you've locked in at a particular rate, and interest rates have moved. So I guess you could say it's that a premium bond is overperforming. I guess. I don't really think about it that way, but I guess it's not wrong. Okay, so we did the bond that had a 5% yield. The bond that had a 9% yield. Anybody want to talk about what the price on that bond would be? Kelly, how about you? There you are. I'm hearing Kelly. Anybody else want to? Chris, how about you? You want to talk about the 9% bond?
Sure. Let's see what I put in present value. So I did the rate has 5%, or 9 divided by 4.5%. My N was 40. My payment was 35. My future value was 1,000, and I got 815.98.
Good. Okay, so when we're locked in at 7% on this particular bond, and yet the yield to maturity on new bonds with similar risk profiles is now 9%, then in essence our bond is selling at a discount because other people can get $90 per year or $45 every 6 months. We're locked in at 35 for a 7% bond, so our bond is selling at a discount of 815,984. Everybody good on that one? Okay, let's pop back over and look at another one. Oh, this is a nice problem. Let me look at this one. That's what we just did. We did those. Okay. All right. This company issued 15-year bonds 2 years ago at a coupon rate of 5.9. The bond makes semi-annual payments. If these bonds currently sell for 105 of par, what's the yield to maturity? Do you want me to put you in rooms, or would you rather just work this for a second? For a few minutes.
This works better so we can see it.
Okay.
And it goes really fast in the rooms.
I know. Okay, go ahead and take a couple of minutes to look at this problem and see what you come up with. And if you would, if your hand is still up, put your hand down. But when you have an answer, put your hand up so I know that that we can go ahead and discuss. Okay, we've got a couple people have it, so take another couple minutes. Okay, Aaron, why don't you tell us what you did on this problem? And it's Aaron with an E.
I'm not sure about the 2 years ago part.
Yeah.
But I did the rate at 2.95%.
Okay.
The N is, I did 30.
Oh, hold on a second. N is, okay. So your N is 30. Now these are 15-year bonds, but 2 years are already completed.
2 years, okay. So I did that part wrong.
Okay. So what would your N be?
So 2 years have already been completed. So
Yes.
28, or is it?
Try
What would
again.
it be? Oh wait, so it'd be 13 years.
Good. So your N becomes
26.
Good. So your N becomes 26. Hold on. Let's let somebody else do another part of the problem. Let's see who else had a hand up. Ed, what did you get for your future value?
$1,000.
Okay, your future value is 1,000. Mike O, what did you get for your present value? Mike O'Neill?
And I was on mute.
I'm sorry?
I said I
Okay.
was on mute. I apologize.
Okay.
Actually, I don't have present value calculated. I'm sorry. I'm still working on a few things on it.
Okay. Kelsey, what did you get for your present value?
Negative 1,050.
Excellent. How'd you get that, Kelsey?
I took 1,000 and then just multiplied that by 1.05, and then I made it a negative since that's what we'd be paying for the bond up front.
Outstanding. Okay, so this problem is a typical problem, a bond problem. So we had 15 years, but 2 years are elapsed. That means it's a 13-year remaining on the life of the bond. So as Aaron told us, 13 years for a semi-annual means we've got 26 more semi-annual payments. Now, as Kelsey just told us, this 105% of par, well, the par value of a bond is 1,000. So that means it's currently selling for 105% of that, or 1,050. And we put that in as a negative number. So, so it's going to be a negative 1,050. Okay, let's see, who else is just dying to answer? Anybody want to answer what you're doing for the payment or what you're trying to find here?
So you're trying to find the yield to maturity.
Which is what in the kinds of problems we've been doing previously? What's it called?
The required return.
Yeah, so we're gonna in Excel, we're gonna be solving for your rate, okay, equals rate, and then we're gonna fill in those boxes. And then Christian, what is your payment amount on this one?
I got 29.5.
Good. How'd you get that?
I just took 5.9% of 1,000. And that's 59, and then just divided by 2 is 29.5.
Outstanding. Okay, so
Sorry,
for this,
how come you don't do the 5.9% of your present value, which is that 1,050?
good question, Wendy, because the coupon is set at the point in time that you issue the contract. So that was 2 years ago you issued this contract, and the face value of the bond is 1,000. So your coupon is always calculated on the par value for the bond, the $1,000. Okay, so always calculate your coupon based on $1,000, no matter what it's trading for now, because we're locked into a contract. Coupon rate was based on the face value of the bond at the time of issuance. All right, so let's go take a look and see what that looks like. Anybody want to provide their answer before we get over to the spreadsheet?
3%.
2.68.
Okay, and that 2.68 is the yield over what period of time?
Just 6 months, so it's 5.36.
Good, good.
Yeah, I got
Okay.
5.36.
Excellent. Okay, so it was a 15-year bond with 2 years remaining. So there's 2 years expired. 15-year bond with 2 years expired, so there's 13 years left in the life of this bond. It makes semi-annual payments, so my N is 26. Face value of bond is always $1,000. They told us the coupon was 5.9%. That's 5.9% of the original issue price of the bond, or 5.9% of $1,000, which is $59 a year in interest, but I get semi-annual interest, so my payment amount will be $29.50 every 6 months. The bond is currently selling for $1,050. As Kelsey told us, it's 105% of par. Par value on a bond is $1,000, so 105% of $1,000 is $1,050. That's how much we pay for the bond today. So we're always going to put that in as a negative number, and we're computing a rate. And our rate is equals rate formula, and then it wants to know the number of periods, the payment, the future value, the type. You can put in 0 because it is an end of period calculation. And then a guess is 0.1. Oops, that's not so good. Oh, I must have left out my present value. Yeah, I think I did. Yeah, I did. Okay, number of periods, comma, payment, comma, present value. There we go. Comma, future value. Type is 0, and my guess is 0.1. And when I do that, it came up with 3%. In bond problems, be really careful about formatting your cell so that you have at least 2 decimal places, because otherwise, if you had just said 3%, okay, double that, it's going to be 6%, you would have been off. When I do a bond calculation for a rate for a semi-annual bond, it's giving me the rate per 6 months. So once I get that number, I have to double it to get an annualized rate. And when I do, I get 5.361%. Any questions on that one?
Yes, I'm sorry. How did I don't remember her name, got the present value to 1,050? Because for you to get the present value, you need to have the rate.
Yep, let me go back and pull the problem up so you can see what the problem looks like. I think I have 2 different versions of these slides open in there. Throw me off. Let's see this one. Okay, so what the problem tells us is that the bond is selling for 105% of par. We know par value on a bond is 1,000, so 105% of 1,000 is 1,050 to get my present value.
Okay, great, thank you. You don't have to calculate the whole present value, you just get it from there, okay.
Yeah, this one, it tells us, so this problem, it's asking for the yield to maturity, so it wants us to calculate a rate. So you can calculate any of these components. I could, if I knew my yield to maturity and I knew my future value and my present value, I could calculate my payment, I can calculate my rate, I can calculate my present value. You usually know your future value. But all of those, we're just using the same formulas we used in earlier chapters to calculate whatever they're asking us for. This particular problem is asking us for a yield to maturity. That means rate. If they want to know what the coupon is, that means payment. If they want to know what the current price is, that's a present value. It's the only, you've done these problems before. The only thing that's different in Chapter 7 is this weird language that you've got to get used to, and then remembering that they're typically semi-annual. So with practice, these become so second nature. You know, I don't usually do Chapter 7 this late in the semester. I usually do it earlier, and so by this point, Chapter 7 just seems really easy because you've done them a bit. We're going to do more of them in Chapter 14, and I think they'll start making a little bit more sense. Let's do, what time is it?
Thank you.
Let's look at one more. Okay, what's this problem asking us to do? What are we trying to find? Let's see who's got their hands up. Kelsey, what are we trying to find?
Okay, so one, 2 minutes. Could we find the payment and then use that to find the coupon rate?
Perfect. Okay, so it's asking you the coupon rate. So what you have to do is find the payment and then annualize that payment and divide it by 1,000 to get to your coupon rate. So for now, just work on finding your payment based on the information that you have here. Does anybody want me to talk more, or do you want to sit and think for a second? If you would, raise your hand when you have an answer that you're ready to talk about. Okay, Joe Johnson, get us started on this problem.
I was still working through it.
Oh, you had your hand up from before. Okay.
But I think I'm there.
Yeah.
Through it.
Go ahead.
So my number of payment periods be 23.
Excellent. Okay. Where'd you get 23?
I just did 11.5 times 2.
Good. So it's semi-annual, so we have 11 and a half years left. So that will be 23 more times that we receive those coupon payments. Good. Okay, what next?
And then my future value is 1,000.
Future value is always 1,000. Good.
Present value is negative 1,080.
Excellent. Your present value is the current price, and it's always going to go in as a negative. So it's a negative 1,080. Okay.
And then for my this is where I think I was getting it mixed up. I have my rate as 3.65%.
You're not mixed up. Perfect. Where'd you get that?
I took 7.3 and divided it by 2.
Okay. Yield to maturity means rate. So it's 7.3% is my yield for the year. For semi-annual bonds, we have to cut that in half. So it's 3.65. Okay. Then what'd you do?
I was getting ready to calculate my payment. If you want to bear with me for 1 minute.
Keep going. That'll give me a minute to switch over.
All right. I got 4170.
Okay, good. 4170, what does that represent?
That represents, I don't know.
Okay, you did beautifully. Okay, let's see. Ryan, tell us how you would continue on with this problem.
So 4170 is the semi-annual payment amount that we receive.
Mm-hmm.
So you would have to kind kind of annualize it, I would guess. So you multiply that by 2, and that's what, 8340. Am I off there? And then effectively convert that into our rate.
By what? What do you do?
So we have to figure out see if I can talk my way through it. Haven't done it yet, but so
you're doing great.
So from the payment perspective, we effectively looked at the percentage that payment represents out of the $1,000 value of the bond.
Yes.
So would we just kind of multiply that by 1,000?
Divide
that by 1,000. Will we multiply it by 2 again as well? Or is that just how we
you
thought
already
the same?
did that once. You did
already
it
did it once. Yep. So
you're
multiply that by 1,000.
Perfect. Okay. So we had 11 and a half years left in the life of this bond, which means my N is 23, 11 and a half times 2. My future value is always 1,000. The rate, this was a 7.3% bond. 7.3% yield to maturity divided by 2 means that my rate is 3.65% per period. My present value is a negative 1,080. That's how much I'd pay for this bond today. So it's a premium bond. When I compute my payment, use the payment formula, I get 41.7. That's my payment per period. And ordinarily I'd be done. But this problem says, what's your coupon rate? And I'm doing this intentionally so you start to get comfortable with all the language attached to bonds. So it wants the coupon rate. So to get from your payment to a coupon rate, you take that 41.70 and double it because it's an annualized rate. That'll get it to 83.40. Divide that by 1,000 because that's the face value of the bond. And Wendy, you base your coupon rate on the contractual face value, not on what it's currently selling for. And so when you divide that 83.40 by 1,000, this is an 8.34% coupon bond. What questions do you have on that one? Pop back over and show you. I think I've got it worked through. Okay, here's all the inputs for it. And clearly I'll post these all after class tonight. Here's the work through, but I went in and did the Excel because I think you guys prefer the Excel files. Okay, we're going to take a break now so that you have a chance to catch your breath a little bit. And when we come back, we'll work on this problem. Let's see. Okay, for this one, what do they want you to calculate?
Yield to maturity.
Maturity.
Yeah, you're finding the yield to maturity, or you're going to calculate a rate. So take let's see, it's 7:55. Come on back at, how about 2 minutes after? So about a 7-minute break. And when you come back, take a look at this problem, and then we'll start back right here in a few minutes.
Before you started this, would you convert everything to semi-annual, or can you just leave this annual?
Okay, this one is an annual, so you do not need to do any of the conversions. All right, Devin, so let's talk about that. Let's see, are we back? Yeah, we're back. Okay, Devin, so talk about this. Based on the fact this is an annual bond, what are you going to do? What are your inputs going to be?
The term will be 15.
The N is 15.
Yeah, the present value is the minus 928.09.
Good.
Future value is 1,000.
Good.
And the payment is 100.
Good. The payment is 100 in this case because this is an annual bond. 10% of 1,000 means your payment amount is going to be 100. So if you would raise your hand when you have an answer to this one. I'm going to switch back over to Excel so you can see it in Excel. Let's see who's chatting. Does anybody have an answer for this one?
11%.
Say what percent?
11.
11%.
Excellent. So we have annual, now you see how nice annual bonds are. So an annual bond, 15 years left to maturity, future value is 1,000. It was a 10% coupon, so 10% of 1,000 means my payment is 100. The present value was a negative 928.09. Remember, we're paying $928. We're going to get back the future value plus $100 every year. And then I'm computing my rate. And when I compute my rate, I get 11%. Okay.
Couldn't we assume off the bat that it's going to be more than 10 because the bond's selling for less than $1,000?
Beautiful. Well, you can assume that that the bond is let's see, the bond is selling below the yield to maturity. So you already knew that that it's selling at a discount. So you knew the rate had to be above 10%. Okay, good. All right, let's take a look at another one. This is where we were. We haven't done this one, have we? Yeah, we just did that one. Okay, now we've got a bond with a 10% coupon. It's a semi-annual bond again, face value of 1,000. Oops. It's selling at $11.97. What am I trying to find on this one?
Payments?
Nope, not payments. Say it again.
Yield to maturity?
Yield to maturity, good. And is the yield going to be above or below 10% annualized?
Above.
Above or below?
Above.
Okay, let's see if you're right. Remember, this is a semi-annual, so take a minute, and when you have an answer, if you would raise your hand. Some hands raised, so let's see. Oh, we got a whole bunch of hands raised. Zenny, I appreciate the applause. That's a nice way to raise your hand. Becky, how about if we start with you?
Sure. So given that it's a semi-annual coupon, I took for the payment, I took the face value, so future value of 1,000, and I multiplied it by 0.1 and then divided by 2 to get a payment of $50.
Excellent.
And then, should I keep going?
Yep.
Okay, and then the end period, so it was 20 years, but given the semi-annual payment, it became 40 for N. And then the present value was a negative $1,197.93.
Excellent.
And then for my IY, I computed rate. So just use the formula and got 4%.
Okay, and then
I should probably multiply it by 2.
Good. Okay. That was a great save. Okay. Okay, Ryan, are you the one that was saying that the yield would be higher than 10%? Is that your voice?
Nope, that was me, and I misspoke.
Okay.
Sorry, I mixed up the yield and the bond so the bond coupon would be higher, so it's selling at a premium. The yield to
Absolutely.
maturity would be
Exactly.
less.
Exactly right. Okay. Okay. Oh, what did I do? I pulled back in the wrong thing again. Well, we can look there because it's, you don't need to see it in Excel. Let's see. So as Becky just said, there's 20 years left in the life of this bond, and it's a semi-annual bond, so my N is 40. The present value they gave us was a negative 1197.93, so it's a premium bond. The payment, it's a 10% coupon bond. 10% of 1,000 is $100 per year, or $50 every 6 months. Future value is always 1,000, and you're computing your rate, your IY, and when you did that, you would come up with 4%. But that's the rate or the yield every 6 months, so we have to double it to get an annualized yield. So my yield is 8%. And it makes sense. This bond is selling at a premium because our bond has locked in a higher coupon rate than what current bonds of similar risks are selling for. What questions do you have on this one? Okay. Now, before you start this one, let's think about this. This is an easy one. We end easily for this chapter. We have a 15-year zero coupon semi-annual bond with $1,000 par and a yield to maturity of 12%. What am I trying to find on this one? What formula am I going to use in Excel?
Present value.
Present value.
Yeah, I'm trying to find what the price is for this bond, so it's going to be a present value. And what is the Ed, what's our payment amount?
Is it 0?
Yeah, it's a zero coupon. So this bond, you're going to pay something for it now, and you're going to get $1,000 back at the end of the life. But there's no payments in between. But it's a semi-annual. So take a minute and work on this one and come up with a price for this bond, and then we'll see how you did. So raise your hand once you have a price on this one. And lots of hands up. Let's see. Zinni, why don't you tell us what you got for this one?
Sure, I'll give it a try. So I have N, it's 30 because of 15 years, semi-annual, so 15 times 2.
Mm-hmm.
And then future value 1,000.
Good.
Payment we said is 0, so no payment.
Good.
The rate is 6%, 12% divided by 2.
Good.
And I get a negative 174.11%. No, the dollar sign, because it's a.
Perfect. Okay, what do we know on this bond? This is actually an easier one because there's no payments in here. It's just the language of bonds to get accustomed to. So it's 15 years, but it's a semi-annual, so there's 30 zero payments. But you still have to convert over because interest is calculated every 6 months on the present value. So you have to do the conversion even though there's zero payments. So it's 15 years, so that's 30 semi-annual periods. $1,000 is the future value. Our yield to maturity is 12% per year, or half of that, 6% every 6 months. And when here's what the cash flow streams look like. And when we compute, we come up with a present value of $174.11. So if you have a bond with a 12% yield and over the course of the next 15 years, given the risk of this bond, you'd be willing to pay $174.11 for it. Any questions on that one? Okay, that's it on bonds. And bonds, the only thing that really is tricky about bonds is making sure you keep the semi-annual straight in your brain. And you have to do semi-annuals because that's what most bonds are. So you've got to get accustomed to that semi-annual component with bonds. Your homework is due before we have class the next time, and it's a homework based on 7, 8, and 10, and so there's a good number of problems in there, but I've got lots of bond problems. There's good problems at the end of the chapter. If it's taking a few minutes to capture this, look back at this video and watch through and do a couple of the problems again. Do some problems at the end of the chapter. Just tell me which ones you did, and I'm happy to check to see how you did if you want to do that before you start your homeworks. Any question on bonds? We're not going to do much in chapter 14, but this is the whole shebang, and I want to make sure that we introduce a couple of quick concepts, and I'm going to leave you with a problem to look at before next time. That is, it's a good challenge, and it will get you thinking about how this whole thing fits together. So that's where we're going to end, and I promise we'll end a little bit early tonight. Since I cut your breaks good and short. Okay, so what the weighted average cost of capital wants us to do is figure out what that rate is. How do we get 12% as a discount rate? If we've got a project that we're pursuing, how do we know what that discount rate is? Well, what we do is we figure out our cost of equity and how much equity we're using, our cost of debt and how much debt we're using after tax, and then preferred if we have that. So that's what our weighted average cost of capital is, and the beauty is we have all of the components. We know how to calculate a cost of equity. We did that with CAPM in earlier chapters. We just learned how to calculate a cost of debt. Taking it after tax just means you multiply it by 1 minus the tax rate. We always use market weights in here, and then you're going to put it all together into a capital budgeting problem. The only thing tough about this chapter is it's why this exam's never comprehensive. Chapter 14 is a comprehensive chapter. Everything comes together in this chapter, so it's just keeping everything straight. And the reason I want to introduce the chapter tonight is so when we're in person next time, we can really work through and make sure we get rid of any rough edges on areas that are still giving you a little bit of trouble in any parts of capital budgeting. Okay, so here we've got a company that has a beta of 1.5, and the firm is 100% equity financed. We have a risk-free rate of 3%, and the market risk premium is 7%. And we want to know what return, what discount rate to use for this particular company. Okay, they have no debt, so the only thing we have to do is calculate our cost of equity. And given the information that they've given us, what are we going to use to calculate our cost of equity? It's two things. You can either do a dividend discount model, or you can do CAPM. You can also do FAMA French, but the book doesn't really teach FAMA French. So dividend discount or CAPM. What do you think we're going to use here? Ed? Oh, I'm sorry, Mike O'Neill?
CAPM.
Good. As soon as you see beta, you know you're using CAPM. And so in this particular case, we know that, that we're going to be using CAPM. And the formula for CAPM is the one that we learned in earlier chapters. So R sub S is my required return on stock, sometimes represented by a K, sometimes an I, but my required return on stock is the risk-free rate plus beta times the market risk premium. And when we put that into this model, it says that we would expect to earn 13.5% on this project. We don't care about the cost of debt because this company is 100% equity finance. So the only cost that's relevant is the cost of equity. Now, the formula for cost of capital, which we talked about a little bit related to your project, it says take the percentage of equity financing you're using times the cost of equity plus the percentage of debt financing times the cost of debt times 1 minus the tax rate. Now let's think about all of this. Okay, so if you look at a company's balance sheet, their stock is carried often at 10 cents a share or a very small percentage, and their stock may be selling for $180 per share. So you never want to look at book values. We always do market value. So you have to go and look at how many shares they have outstanding, what's the share price to come up with the market value of equity, times their cost of equity. And the vast majority of companies use CAPM. So almost always you're going to use CAPM to find your cost of equity. Now for debt, same thing, we want the market value of debt, but that's hard to get. I said earlier, most debt is not traded. People acquire a debt issue and they hold it to maturity. So, and bond prices don't vary a whole lot from their issue price. So even though we say we want to use market values, we often use the book value of debt. But technically you're using a market value of debt times your cost of debt, or the yield on debt that we just learned how to calculate, times 1 minus the tax rate. Why do you think we have that 1 minus the tax rate in here? Why is that in here?
Because we get is there a tax credit because of the debt?
In essence, remember earlier when we were calculating operating cash flow and we said it was EBIT plus depreciation minus taxes because we didn't want to double count for interest expense. We kind of ignored interest expense. Here's why we ignored interest expense. Because when we calculate our cost, our weighted average cost of capital, we subtract out, we multiply our cost of debt times 1 minus taxes to take into consideration the fact that interest expense is tax deductible. So here's where we take into consideration interest and how it impacts our overall firm value. So our cost of debt is always lower than our cost of equity because debt's a cheaper source of financing than equity. And it's even lower because of this wonderful tax advantage that we have with debt. So this is the weighted average cost of capital formula that we're going to use nonstop for the rest of the time we're in this class. Here's the version of the formula that equity is stock plus bonds. I think this is the version the book uses. It's the same thing. It's just that in finance we have so many different words for the same thing. Stock and equity is the same thing. Bonds and debt is the same thing. R sub S is required return on stock. R sub equity is required return on equity. I believe I have your formula sheet already posted, so you can take a look and see which version of the formula I use, just to make sure that you're familiar, that none of the language here trips you up. Okay. Here we've got a company that has, stock has a beta of 1.17, the risk-free rate is 3.8%, and the return on the market is 11%. We're going to calculate their cost of equity. So take a minute and do that. Let's see if I've got the formula in here. I do have the formula, but then you won't be able to see it. Sorry. You would raise your hand when you have an answer. Okay, Joe, how did you do? Joe Johnson.
Sorry, I didn't raise
your hands. Okay. Putting that hand down is a whole lot harder to do electronically, isn't it? Let's see, who else do I have over here? Haven't talked tonight. Chris Manley, what did you get?
So hopefully I did this right, but I did let's take a look at my formula. I did the risk-free rate of 3.8% plus the beta times, which is 1.17 times 11%, and I got 16.67.
Yeah, you made the most common mistake with these problems. Okay, here's the formula. The only thing hard with cost of equity problems is deciding what they've told you. This one said the market return is 11%. That means that's just this.
Yeah, that's what
so
I
you
figured.
have to subtract out the risk-free rate. So if they tell you it's the market risk premium, it's all of this. If they tell you it's the market return, it's just the R sub M, and you have to subtract out the risk-free rate. The only thing tricky with CAPM is paying attention to the language. So market premium is this. The first problem we did was a market premium. Return on the market is, return on the market is just this piece, and you have to subtract out the risk-free rate. Other than that, you were spot on.
Awesome, thanks.
Okay, so we have a beta of 1.17, we have a risk-free rate of 3.8, and then we have a return on the market of 11%. So our overall cost of equity is 12.22%. Do you have any questions on that one? Okay, let's look at, okay, this is a straight out of Chapter 7 problem. You just learned how to do these. So take a minute and now it's asking you for the after-tax cost of debt. That means you need to find the yield to maturity or the rate and then multiply that by 1 minus the tax rate. This is a semi-annual bond. So take a couple of minutes. If your hands are up now, put your hands down so I don't call on you. And when you have an answer, if you would put your hand up. You can put your hands up when you have an answer. A couple hands, anybody else? My hands just disappeared. Okay.
Sorry.
You're good. All right, Mike, tell us what you did. Mike O'Neill.
We'll try. Okay, so cost of debt. So I'm just going to break it down in order here. So my N is going to be 13. Well, it'll be 26 because it's semi-annual.
Okay.
95% of face value, so that's 95% of 1,000. So my present value is 950.
And you're going to put that in how?
As a negative 950.
Good. Okay.
Make semi-annual payments, has a coupon rate of 7%. So my semi-annual payment will be $35.
Excellent.
Pre-tax cost of debt.
Ignore that for now. That we do that after we calculate your cost of debt.
Okay, so the cost of debt I have is it, well, the semi-annual is about 1.9%, and then annual will be about 3.8.
Beautiful, beautiful. Okay, look at what Mike did. Okay, it has debt outstanding with 13 years to maturity. 13 years, but it tells us it's semi-annual, so that means there's 26 more payments. 95% of face is the quoted price. That's the present value. So 95% of 1,000 means the current price is $950. We put that in as a negative number. That's how much we would pay for this bond today. Future value is always 1,000. Semi-annual coupons of 7%. 7% of 1,000 is $70. Semi-annual means it's $35 every 6 months. And then, yeah, they tell us about this yield, this tax rate and such. That comes after. We first have to calculate our yield on this, or our rate on this particular problem. And when we do that, we compute it. When we compute the rate, we're going to get 3.806. That's per period. And so we double it to get to 7.6125. Okay, that's the first part. And now the last part says, well, the tax rate's 35%. All we have to do then is multiply the 7.6% times 1 minus the tax rate to get to an after-tax cost of debt is 4.95%. And that's really nice and low, especially when you look at the cost of equity. They're so much higher than this. So we go from a 7.6%. Remember, these costs are costs to the company. They want these numbers to be as low as possible. So debt is good in that you're able to reduce the overall, you're able to reduce your taxes as a result of the fact that you use debt. Any questions on that? Go ahead.
Yeah, so I may have misspoke. So is the annual rate 7.61 or is it the 3.8? I may have misspoken.
7.61 is the annual rate. The 3.806 is the semi-annual rate that you computed. Everybody good on that one? Okay. Look at this one. So we've got a capital structure, 70% stock, 30% debt, cost of equity of 11.5%, cost of debt of 5.9%, and a tax rate of 35%. What's the company's weighted average cost of capital? Well, we put it all together in that cost of capital formula. There's our formula, and so we know that we have 70%. We have 70% equity times a cost of equity of 11.5%. If we're 70% equity and we don't have any preferred, that means we're 30% debt times a cost of debt of 5.9% times 1 minus a tax rate of 35%. So once you've calculated your cost of equity and you've calculated your cost of debt, putting it in the weighted average cost of capital formula is actually the easiest thing about these problems. When we do that, we come up with a weighted average cost of capital of 9.2%. Okay, that's all we're doing tonight, except I want to show you one more thing. And this probably looks pretty ugly. If you can do this problem, you aced this class, okay? So this throws everything together. This says, okay, how do we calculate our cash flows? How do we calculate our cost of debt, our cost of equity? How do we put it into a weighted average cost of capital formula and arrive at a decision on this particular project? It's a really good question. And because we have 2 weeks, I want you to look at it between now and then. So I'm going to post clearly all of chapter 7 and chapter 8. Those will all be posted. I'm going to post everything up to this problem in chapter 14 so you can look at it. And I wanted to get this far because you have 2 weeks to kind of contemplate this and look back through. So if figuring out your cash flows is problematic, look back through, because when we meet again in 2 weeks, that's the last week before the exam. And I want to make sure we have plenty of time to answer any questions about any part of this. So I want you to have spent a little bit of time on it. The homework that's due just before our next class, so the Wednesday after Thanksgiving, is for chapter 7, 8, and 10. It's all combined into one. So that's due then. Your weighted average cost of capital isn't due yet. This problem, take a look at, and we'll talk about it in class. If you get stuck, feel free to send me a note, and I'm happy to try to unstick you. But if it's just, if you're really struggling, I want you to go back and look at the calculating cash flow chapter. I want you to look again at chapter 7 on how we calculate bond yields, and then look at CAPM again for whatever piece is giving you trouble. And if you get stuck on one piece of it, start working on another piece just to familiarize yourself with this as much as possible before we meet next time. This is a tough problem, and I wanted it to be a good hard one so that you had something to really challenge yourself, and so you don't leave class next time and I build to a harder and harder problem just before you're getting ready for an exam. So let's start next class with a hard one, and then we'll work on some others that just aren't quite as challenging. What questions do you have on anything that we've covered up till this point tonight?
I have a homework question. Do we have one homework due or two? I thought it was 9 and 10 were together, and then 7 and 8 were in another.
Oh, are they? Did I split them out into two? It's possible. Everything through chapter 10 is due. So if it's I have it on the syllabus as 7, 8, and 10. But if it's in Connect with two separate homeworks, please do them both. Sorry about that.
Got it. No worries.
Any other questions? Okay. If you make good progress on this problem, you should have a real sense of accomplishment. And if you don't freak out. We're going to go over this next time too. But come to class in 2 weeks as prepared as you can with any aspect of this that gives you problems. So you can look back at all of the earlier chapters and figure out where you ran into a problem. Because I can assure you on the final, you're going to calculate a weighted average cost of capital. And that means you'll have calculated a cost of debt. You'll have calculated a cost of equity. You're going to do a capital budgeting problem. So this is everything. I couldn't do this on the exam because it would take you too long. But this, if you can do this, you can do pretty much every part of the exam that I can throw at you. And you know, there's only so much football you can watch on Thanksgiving, and there's only so many dishes you can wash after you eat turkey. So, so if the relatives are making you crazy, go sit. Tell them you got homework to do. Go sit and work on this problem a little bit. I'm going to be around in the next 2 weeks, so let me know if you have any questions. We don't have class next week. It's Thanksgiving, and then we're meeting in person the week after that, which I think is December 5th, I believe. Oh, I can't believe we're talking December already. Any questions before we wrap up? Have a good Thanksgiving. Be safe if you're traveling, and let me know if I can help over the course of the 2 weeks, and I'll see you in person in 2 weeks. Bye, guys.
Thank you.
Thanks.
Have a good evening.
Thanks.
Thank